Bonsoir, je suis André Pronovo, membre du conseil d'administration du chapitre Fort-Saint-Jean. Tonight, I am pleased to present the Investing 101 with Portfolio HiWay. This one-hour webinar will be given by Liam, Ryan, and his team. Although it will be in English, they are able to take a question in French and answer to them. Liam is a great friend of mine. He participated, and on behalf of John Caswell, CEO of Kenzo Group, he helped me to organize winter reunion on December 4th, 2025. Lion is president of Alumni Association and manager of Affinity Programs, lies in their funds. So ready to go, Lion? It's all yours.
Oh, that's perfect. And good evening, everyone. Thank you so much for the kind introduction, Andre. Bonsoir tout le monde. Merci de vous joindre à nous. So as Andre said, my name is Liam Ryan. I'm president and CEO of Canadian Alumni. And I'm also an ex-cadet as well. Je suis très enthousiaste à propos de cette présentation ce soir. Je tiens à remercier le chapitre d'avoir organisé ce webinaire, car je pense que ce sera une séance très informative pour tout le monde. Just a little bit of a backstory, as Andre mentioned, we do host the CMR Winter Reunion every year, and Andre had the idea that we host a webinar because we have our connections within the financial industry. It would be great value to the Canadian military college community. So here we are today, and we're really excited to be having this presentation for you all. Quickly, just what Canadian Alumni is, our whole mission is to build stronger communities. So we help communities increase their engagement and provide tools to support the organization, and in turn, that creates growth for the community itself. We aim to make communities more connected and create a value proposition for your membership. And so we're currently beta testing our product with the Canadian military college community. And really, this community was the inspiration for developing Canadian Alumni. I'm an RMC alumni myself. Our founder, John Carswell, is also a CMR RMC alumni. And so we see how strong this community is, and we want to give this community the tools to become even more connected and really optimize that experience. So part of the value proposition that I mentioned before is to bring in experts from their fields so that it can help increase the well-being of each of the individuals part of the community, and also the community writ large. So I'm very pleased to welcome Dorrington. He's the head of trading at Portfolio HiWay. He's also a graduate of RMC to talk about some of the main tenets of investing. I think we're all, as Canadians, living in a world of kind of uncertainty, especially with the markets. So I think this would be really valuable information. It's hard with so much information that we're receiving on a day-to-day basis. It's hard to discern what is fact and what is fiction. So I think it's a really great opportunity to have an expert like Jordan talking to us all today. So just a few housekeeping points before I hand it over to Jordan. So as Andre mentioned, the presentation will be in English. However, we will have translation available. So please interject throughout the presentation if you need some clarification. We have a comment box, so enter your questions in the comment box, and we'll make sure to get those answered promptly for you. Okay. So without further ado, I will hand it over to Jordan Dorrington.
Good evening. I think we might just dive right into it. Here we are, slide. All right, so as Liam mentioned, my name is Jordan Dorrington. By way of registration, I'm a portfolio manager. I'm a CFA charter holder, and I'm the Vice President of Wealth Management, and I'm the head trader for Portfolio HiWay. My team and I manage about just under $1 billion on the private wealth space, and collectively our companies are about $65 billion. I'm a proud graduate of the Royal Military College in Kingston in the year 2012. If anyone is counting, 25397 is my college number. Let me know if I owe you some beers. I'm happy to send those via FedEx. Okay. Generally speaking, the world is a pretty tumultuous place, and there is quite a bit of information coming at you. And so what I thought, although our mandate was quite vague for this evening, or broad, I should say, for this evening, what I thought was we'd give you a couple of things to think about that are irrespective of sort of what's going on in the economic or political climate. And there are some pretty basic financial principles. I think for the most part, you're going to already know these things, whether it's in the front of your mind or the back of your mind. But nonetheless, it's going to be a pretty good reminder. I've left ample time at the back end, at the end of the presentation. If you have any questions about markets, or you have questions about what accounts to be using, or what stock, whatever you choose, it's your time. I'm happy to do that for as long as you need this evening. My prepared remarks are probably 10 or 15 minutes. If you have any questions during the presentation, feel free to stop me. Slide. Again, these are things that you're probably already knowing, but the four things we're going to talk about today is, firstly, the power of compounding, and it is how starting early and being disciplined can lead to large gains after some time. The second is diversification. We're going to prove that with a couple of graphs. They're easy to consume, but in a couple of ways: stocks, geography, spreading yourself out, spread the love, as we say. That can be very beneficial. Third is we're going to talk about losses versus gains. They are not the same. And we'll look at that, especially as you get closer to retirement, or you're in retirement, or you get closer to your goal, if that's a house or a car or whatever. Losses are different than gains. You know that, but I mean, mathematically, we'll see. And then being mindful of how much money you're giving away, right? And for the most part, that's in fees and taxes. We all pay more than enough in taxes, and we want to make sure that you're not paying too much in fees. So we're just going to look at a couple examples of where you can keep more of your money. Getting into it, slide. Okay, we've made a couple of assumptions here, but if you saved, and we can change the numbers, I've done it with smaller numbers in case you're an officer cadet or you're younger. I can't quite see the participants, but all to say, if you saved $1,000 a month for 2 years and you earned 8%, that's an average middle of the road return. After a couple of years, 2 years, you would have 10% more money. Okay, you'd have 1.1 times your money. It's more than if you had just kept the money in the bank. Okay, but by no means is this, we're going to Vegas, we're going to Singapore type of change. Slide. After 15 years, however, you've doubled your money, right? So if you're a diligent saver, you keep putting it away, you keep earning a reasonable amount of return, well, suddenly you have double the money. Don't look at it every day. I mean, we'll talk about why psychology-wise that's probably not a good idea. But generally speaking, be disciplined, treat it as an expense, and you can see that line begins to be non-linear, begins to look more like a hockey stick. Go Canadiens, right? It starts to creep up. Slide. And if we're talking about saving for retirement or something over the very long term, that becomes a massive difference. So over 25 years, you have 3 times your contributions. And so for amount of money off of your paycheck that you might find reasonable, we've used $1,000 as an example. We're going to use big numbers all throughout this evening just for illustrative purposes, but $100, that becomes $80,000. $1,000, $951. The point is, and it is very simple, over a very short period, a regular disciplined savings plan might not feel like it's worth it, but over longer periods of time, over longer terms, if you are disciplined and you are consistent and you treat it like an expense, like your mortgage or your car or whatever, it doesn't matter what you're saving for, you can make quite a bit of money later on, and that relationship is quite strong in the later years. I mean, we could extrapolate this till 40 and 50 years, and this number goes to well over $2 or $3 million. It's a non-linear relationship. So, but you only experience that if you started early, if you laid the foundation. And the point here is that I want you, no matter what's going on in the economic climate or the political climate, treat investing and saving like something you must do, and be very disciplined about it. Okay, that will pay incredible dividends, literally, later on. Slide. Diversification. This is my second point. Imagine again, I can't see who's on the call, but I imagine some of you are old enough to remember. Imagine for a second the year is 2007. What phone did you have? I mean, odds are it was a BlackBerry or a Nokia. But odds are it certainly was not an iPhone. In the first 2 years that the iPhone existed, Apple sold 1 million of them per year. BlackBerry sold 1 million BlackBerries every month. And so if at that moment you said, I have money and I want to buy a tech stock, which one would you have bought? And I mean, some of you would have been brilliant enough to know that Apple was the future, but you couldn't be blamed, and you would not be alone if you picked BlackBerry instead. And we've seen this story in other ways too. Nortel is a great example. In the energy space, Enron is a good example. I mean, for different reasons, but in the end, the most money that you can make is by picking an individual stock. It's also the most money that you can lose. Slide. The red line is the NASDAQ, which is 100 tech stocks. And the worst performing ones get dropped out every year and new ones get added. And so again, let's go back to 2007, 2008. If you had some money and you said, I'm going to pick, between the two, Apple or BlackBerry, you would have said, I'll make the most money by picking Apple. What's actually not necessarily true. You would have experienced a pretty similar trajectory if you had spread out your investment over 100 tech stocks. And what you get is a very similar amount of increase, very similar amount of upside, but you limit your ability to lose all of your money or that BlackBerry style downside. And so my point to you is this. If you're going to invest in risky assets, stocks, bonds, whatever, try to spread yourself out between companies, between industries, between sectors, because you don't, over 10, 20 years, you don't give up any really of your upside, but you protect yourself from the downside. And this is a great graph. I use this all the time. I mean, this is a phenomenal illustration of the fact that, yeah, I mean, you might like a company. That's great. Don't put everything in it. Just pick a couple other things. And if you're going to pick other things, maybe you have an energy and a gold. Maybe you have other countries, other currencies. The point is diversification does not hurt you on the upside, but picking one individual name can hurt you quite a bit on the downside. Slide. This is a great graph as well. This is geography. So for 5 or 10 years now, maybe 7 or 8 years after 08, certainly, the United States market, equity market, has been the strongest in the world for the most part, especially translated into Canadian dollars. Why? I mean, that is probably the biggest economy in the world. If you're an inventor and you have a new amazing idea, where are you going to go to bring that idea to market, to find the funding? For the most part, for better or worse, that is the United States of America. And as a result, money has piled in. And so many people's portfolio end up being overweight or too much US. And that would have worked out for you for a bit. We saw, you can see that big dip at the beginning there, at the end of March, beginning of April. That's Liberation Day. That's when he brought in all the tariffs. Regardless of where you stand politically or the political climate, again, the U.S. market didn't respond well. I mean, it bounced back, but you would have done better being in European equities. You would have done even better being in Mexican, Chinese, and South African equities. You would have done even better being in Canadian equities, and even better yet in Japanese equities. I'm just picking a couple of random places. For the most part, the US was one of the worst performing areas last year. And my point again is simple. If you're going to invest, and I very much encourage you to do so, as disciplined and as an expense, spread it out, spread the love, because what you want is a portfolio that is generally going up, but when individual things go down, other things are balancing it out on the way up. And you can do that using diversification. It's one of the many theories called portfolio theory, but so long as everything is not correlated perfectly, you get all the upside. You get to match the amount of up over 10 or 15 years. You match the up, but you give up the down. So spread it out. Spread it out by stock, spread it out by industry, spread it out by geography. A couple of simple graphs to illustrate that point. Slide. Okay. Losses and gains. This is a pretty interesting relationship. If I said to you, you're going to buy a stock, and on Monday it goes down by 25%, and on Tuesday it goes up by 25%, you've broken even, right? Wrong. You've lost quite a bit of money, actually. Now let's say on Monday it goes down 25%, and the next day it goes up 30%. You're up 5%, right? No, you're still down money. In fact, it takes quite a bit to be able to recover your losses. And that is because losses, on an anecdotal level, the pain of a loss is greater than the joy of a gain. The pain of a loss in economic psychology lasts longer than the joy of a gain, right? If you've ever been to a casino, not that this is gambling, you've ever been to a casino, you know that, right? If you lose everything, you are in despair. It lasts a long time. However, if you win, it's pretty exciting for a couple of minutes. You high five a couple of times, and then what? You just go on about your life. Losses hurt more mathematically and anecdotally and psychologically more than the joy of a gain. Slide. The point is this: as you get closer to your goal, if it's retirement, or you're buying a house, or you're buying you've always dreamt of buying a Rolex, whatever your goal is, it doesn't matter. As you get closer to your goal, you should be taking chips off the table. You should be de-risking or making your portfolio less risky as you get closer to the goal. If you were 1 year away from retirement and your portfolio went down by 20%, 10% even, you're working. You still now need to go to work for the next half decade, right? For what? To get 5% more? It doesn't improve your retirement materially, but it does destroy your ability to retire. Losses are bigger than gains. Slide. Just to illustrate, here's an example, and here is a strategy. If you were to keep 5%, whatever your investment portfolio is, it might be $100, it might be $100 million. We have both on our books. Keeping 5% of your money in cash means that you don't give up a lot of the upside. You don't. But if there is a correction or a downturn, liberation day, which we saw on the previous graph, it's like an airbag on the way down. It makes sure that your losses are not nearly as grave. And if you have the wherewithal and the advice and the right investment advisor or counselor to help you, you might be able to buy in at the right time, even if it's averaging down. And it means that you have more profits when it goes up, right? So keeping 5% in cash is an airbag for downturns, almost like a booster on your way back up, okay? And so this is a bit of a theme for me. My colleagues hate that I do this, but I like to summarize and recap. But my point to you is this: losses hurt more. If you starting to get close to your goal, investing more and investing in something riskier doesn't make the goal come a lot faster, but it does destroy your ability to get there. Okay, so you should be de-risking, taking chips off the table, And just generally speaking, as a principle or something to keep in mind, having just a little bit of cash, just a little bit, 5% of cash or something very liquid, can really protect you or act as a bit of an airbag on the way down, and can actually magnify gains when things turn around. Slide. Ooh, fees. This is critical. We might spend some time here. Fees, we've all seen I think it's Questrade. It might be Questrade or Wealthsimple, but one of those brokerages, they make commercials every week about how fees destroy your ability to get to your goals. And although they take some liberties in how they present that, it's not entirely factual, nonetheless, they're not wrong in principle. And it is that fees eat into your ability to make a return. And the graph that we showed earlier, this is a zoom in on just on the tail end of that. But being disciplined and saving properly at the beginning, and then paying fees, exorbitant fees on top of that, means that line doesn't get to go up, not in that same hockey stick way. You really need to be mindful of how much you're paying in fees. And so this is a zoom in, as I said, at the 25-year mark. Let's say you were a diligent saver and you had a good rate of return and you got to $1 million saved. Good. Perfect. And you never paid fees. It's almost impossible, but you never paid fees along the way. You would have $1 million. If you paid very little fees or half the normal fees, which is the fees that we charge at my shop, you would have almost $1 million. If you go to a bank, if you walk into a bank today and you said, oh, I need some help, someone help me with my portfolio, they're probably going to charge you 1.25%. Over the course of 25 years, that's going to cost you almost $200,000. It's quite a bit of money. And so my point to you is simple. If you have an investment counselor or a financial advisor or an investment advisor, it is your right, and you should, at every meeting, ask them, what am I paying in fees? What am I paying in fees? And if the number is more than 1, I can tell you now that is an unreasonable amount of money. It's too high. It's far too high. If the number is 1%, that is now also too high. It's too much money. There's no way you are deriving 200,000, almost 20% of everything you've ever earned. You're giving away. What have they done for you? Have they given you that much? Maybe. The answer might be maybe. But for the most part, this industry charges too much in fees. And I want to make sure that you're asking the question because it's your money and you should keep it. My second point to you here is the hidden fee. So, especially if you're younger, you're probably on Wealthsimple or Questrade. And again, these are great platforms. I have no real gripes with them whatsoever. You don't get any advice or guidance, but you can do what you want to do for the most part. Great. They say they charge no fees. Okay. But yet they make billions and billions of dollars every year. How? How is that possible? Well, 2 ways. Firstly, they're selling your data. They might say they're not or whatever. They're selling your data. They sell your information. Okay. That's the first thing. Secondly, you should be aware of that. Secondly, is they front run you. And so what that means is every time you buy or sell something, the price that you're buying at is not the actual price, right? It's like, what's an example? It's like Uber Eats, right? If you buy a Happy Meal, I have 2 small kids. If you have a Happy Meal and you go buy it from McDonald's directly, you pay $5. But if you buy it on Uber Eats, it's $6. That difference, that's how they make their money. The things that you buy and sell is not the actual price. That's important to know. And so if you transact a lot, if you're a day trader and you're making a lot of transactions, that adds up quickly. There is one very finite scenario where those platforms are best, and it is if you're a buy and hold investor or you don't transact very much, and you don't need advice, okay? But as you get closer to retirement as you begin to accumulate real money, it might behoove you, it might help you to be able to have someone with some tax planning and some estate planning, right? How do you pass on your money to your kids or your grandkids in the most effective way so that they don't have a tax bill? That kind of thing. That's where Portfolio HiWay is very, very powerful. And again, our fee is about a third of everyone else. It's worked out very well for our clients so far. But this is not a solicitation. I'm not saying that you should come to see me, but what I am saying is whoever is helping you, make sure you're very clear and upfront on how much you're paying. It is your money. Do not give almost 20% of it away and eat into your retirement so that they can go golfing. I mean, once you retire, let's be staying at the Four Seasons and not the Howard Johnson. It's kind of my point. Slide. Okay, this is phenomenal. This one's a lot of fun. So let's say you had some money and you wanted to keep it very safe, very, very safe. You didn't want to take any risk. This is just an illustration. These are two real numbers that I got yesterday. So this is a real example, but let's just invent a person. Her name is Chanel. Chanel wants to save her money, something very, very safe, just keep up with inflation. And I said, Chanel, you have two options. You can buy a GIC, which is going to give you 2.6%. It's guaranteed and it's safe. Okay. And here's option B. It's the government bond. It's going to pay 2.3%, which is less. But it's guaranteed and it's safe. Which option would you pick? Most people would pick the GIC, right? Slide. In actuality, and we can get into the machinations of capital gains versus income or Canadian dividend taxation, but the point is this. The thing that yielded less, the thing that promised you less, actually paid you more. Why? Because of taxes. The number one expense of every household is taxes. At least half, for the most part, half of your money is going to the federal government. How they use that is something we don't have to get into. I feel like in this community, we're all agreed it should be on planes, tanks, and boats with guns on them, but that's a different discussion. The point is, your number one expense is taxes, and I don't know about you, I think I've paid my fair share. I don't need to give away more, especially of my investments and my retirement and my home purchase money, more of that in taxes, okay? And so at Portfolio HiWay, all of our recommendations are extremely tax aware. We try to make all of our investments as tax efficient as possible because what actually matters, it doesn't matter if you make more money over there. If you have to give all of it away to the tax man, you haven't made any money. The actual money that you keep in your household, in your pocket, to buy groceries for your kids, to make your mortgage payments, to do the things that it takes to run your household and save for retirement and save for what you want, that is after-tax income. That's called after-tax income, after-tax returns. Not all investments are created equal. Even though something might look like it makes more money, after tax should be the consideration, should be the number one consideration. Right? There's like, what is my risk tolerance? What am I saving for? And then right after that is, how can I not pay taxes? And that doesn't mean tax evasion. We're not doing anything illegal. That just means picking the investments are the most tax efficient so that when it comes February, March, and April every year, you get a tax return and you don't owe the CR anything, because once they come knocking, it's over, okay? And so my point to you is simple with respect to fees and taxes. That is your money. You own that money. You've earned it. You've worked hard for it. You've saved it. You've been diligent about it. Give less of it away, okay? And on the surface, it is difficult to tell who has their hand in your pocket. But I can assure you, in finance, a lot of people have their hand in your pocket. We want to protect you from that. We want to keep them out of there. We've all paid enough in taxes this year already, and certainly you don't need to be paying those kinds of fees. So be aware of it. Make sure it's a part of the discussion that you have with anyone that is running your money. And if you're doing it yourself on a brokerage, like a self-directed brokerage platform, just be aware of how much you transact, because every time you do anything, they get something. Slide. Very good. I tried to be 15 or 20 minutes, but that concludes my prepared remarks. And my conclusion is this. One, again, I can't see who's on the call, but if you're young or middle-aged, if you're anyone and you have a goal, start early and be disciplined. Not after 1 or 2 years, it's not going to feel like it's doing anything. Fair enough. But after 10, 15, 20 years, that line starts to aim itself up, up, up at the moon. And there's actually a phenomenon in high earners that is they get to retirement age and they don't want to retire. And the reason is because they don't want to start drawing on their retirement funds because it's going up so much. Once you get to the end of the road, that is when things start to aim at the moon. Okay? Which brings me to my second point. Diversification. Once you get closer to your goal, it's important, and there's a balance to be had, but you can still take more moderate risk. For example, buy NASDAQ and not NVIDIA, right, as you get closer. Or buy corporate bonds, right? You get 8% instead of 14%, that kind of thing. You can still get a return, but as you get closer to your goal, take money off the table, which is losses and gains. And finally, give less of your money away. Give less of your money away. Give less of your money away. The number one thing you can do for your portfolio is paying less in fees and paying less in taxes. You can just create 1 or 2% per year, which compounds and compounds and compounds every year just by giving less of your money away. That's very powerful, and that's entirely in your control, which the markets, you never know. They go up and they go down. You can't really control that. There are things that are in your control, and it is how much of your money you keep. And we think that's very important. Slide. That is this slide is the extent of my French, so I do apologize. Although Francois is here, I think we got some folks on the line who can do any translation if required. But again, I'm a portfolio manager, CFA charter holder. My investment book and my colleagues and I invest across the entire spectrum. So if you have any type of questions at all, please let me know. What if you start late? What are your options? That's a good question. Essentially, you have 3 options. Okay, the first is make a sacrifice now. That is, either you start reining in vacations or investment properties, if that's where, or how much you golf, or where you maybe Loblaws versus no frills. That you make a sacrifice now. That's option 1. Option 2 is you make a sacrifice later. So you say, I am in retirement going to do less. Okay, or I'm going to buy a smaller townhouse instead of a detached home. Or if you just rein in the goal, so you rein in your now or you rein in your later. And the third option is you take more risk. For the most part, not necessarily right now because the markets are quite elevated, but for the most part, more risk should over the long term equal more return. And so you have to balance one of those 3 options. Either you, and maybe it's a combination of the 3, right? Maybe you save a little bit more by sacrificing something. You say, okay, in retirement, I'll have to spend less, or I won't be able to leave as much money to my kids, or whatever. You make a sacrifice now or later, and you take a little bit more risk. Those were all really good options. And the last thing is make sure you're reining in the fees. Make sure for you, if you start late, it's especially imperative that you give less and less of that away. Anything else? I'm happy to talk about markets right now or anything at all. I'm willing to dedicate as much time as you need.
Hey, Jordan, I think another question that came up was I think crypto has been getting a lot of interest these days. Can you maybe share your insights on your views as crypto as...
That's a great question. So crypto there was a time that traditional asset classes, as they went up, crypto went down. And they would flux. It was an alternative asset class. It's something else that you could do, introduce in your portfolio. That is no longer the case. Crypto now moves independently. Okay. Since October of last year, crypto is down, I think, 45 or 46%. Remember the power of losses? That means that you need to make like 120% to get that back. Okay. The promise of crypto is to make a lot of money fairly quickly, backed by nothing or very little. I would be wary of that. Anyone who says, give me your money and I'll be back soon with lots more money should raise some hairs on the back of your neck. Now, crypto exists. It's a great way of hiding money. So it will always exist because there's a lot of people trying to hide money, but you're investing alongside some pretty sketchy characters. And so all to say, crypto could, especially if you're young and it's interesting to you, it's very volatile, but if you take a portion of your portfolio, whether that's $100 or $1,000 or $1 million, whatever your portfolio looks like, and you invested in crypto just for fun or just to say, hey, a small thing can become a big win, no problem. I have no qualms with that whatsoever. But if that's the base of your portfolio, it's not tied to anything. It's not tethered to anything. A stock, you own part of Apple. You own it. A bond is a debt. They owe you. Crypto, I mean, who owes you what? How do you get, if they start locking down the exchanges, how do you get at it? It can be a bit risky. And so all to say, it can be a part of your portfolio. It can be 10, 15, 20% of your portfolio, no problem at all. But it shouldn't be the heart of your portfolio. And it's very similar to gold, which is a segue to myself, fair enough. But gold is another alternative asset class. Gold, silver, copper, materials. Canada, especially Canadians, we have a lot of exposure to that because it's a big part of our economy, the financial sector and the materials sector. And so we've seen gold as well have a hockey stick run over the past year. Silver even 10 times that. And so once you start to see that shape, that acceleration of a price, again, you should be wary because there's a group of people that are investing in that asset because they believe in it. And over the long term, they want to own it. And then there is another group of people who are buying that asset because they know, 2 weeks or a month or 6 months, they can sell it and make a big profit. And the problem is when all those sellers decide to sell at the same time, you have a very similar drop off in price and you cannot get out in time. And it really goes back to diversification. I have no qualms with gold and silver, oil, copper, crypto being part of the mix. You should have it as part of the mix. But make sure that you are spreading the love, right? In Canadian dollars, the Brazilian stock exchange in January is up 25%. Crypto's down 40%. I mean, you can't predict that kind of thing, but if you spread yourself out enough, you protect yourself from the down and you get to participate on the up. Has this presentation been made to RMC cadets? If so, any new investors have shown up?
I can take that one.
Yeah.
I can take that one, Jordan. Yeah, so we're always welcoming RMC cadets to join any of these types of webinars. In fact, I think there would be a lot of value for the cadets. In some cases, it's difficult to access the cadet wing. Jordan and I, again, we're always available to do that. So if there is interest, I think with some help from either the Fort St. Jean branch or the RMC Alumni Association to help socialize the benefit that having someone like Jordan as an ex-cadet to talk to the cadets, always more than happy to share his expertise.
Thank you. I fancy myself pretty cute. Thank you. I think he's talking about Liam's beautiful daughter. Okay, so I guess we'll leave it then. Translation.
Yeah, so Jordan, the question, what percentage of the portfolio should be allocated to bonds?
Bonds are fascinating. So bonds, similarly to stocks, right? Bonds vary a lot in terms of those, how much you're getting. They're not all one thing. A GIC is all the same. Every GIC you get is the same. Okay. Every toonie or loony you get is the same. They're all the same. Bonds, and they differ quite a bit. In the stock world, you have small cap stocks, which are very volatile. They go from $1 to $50 to 10 cents. And then you have large cap stock, which are stable and they pay dividends. The same type of relationship exists in the bond world. And I am getting to the answer to your question. So high yield bonds are debt obligations that are owed to you by companies that are not that great. You're not certain that you're going to get paid back, right? Because a bond is a loan. You are loaning a government money or you're loaning a company money, and you want to get back your principal and your interest. Those are the coupon payments. And so those very speculative bonds, you might consider them more like equities. Okay, so what percent should be bonds depends on which bonds, right? Because high yield, they're called high yield. High yield bonds are more like equities. But generally speaking, bonds are safer. Bonds are, again, they're loans that you are owed. And so if you say, hey, I'm going to buy an Apple bond, you can be fairly certain that Apple is going to pay you back. In fact, Apple has more than enough cash to pay all of its debt back today. And so that would be very safe. And then even safer than that is the federal government. If you can say, hey, I'm going to lend the federal government money, you're certain they can pay you back because they can just tax it or print the money. They can print it digitally. They can just pay you back. It doesn't matter. So there's varying degrees of risk in the bond portfolio. Now, to answer your question, let's just aggregate them into an average bond. If you're very young, you're 20 years old, you should have maybe 10% in bonds. Why? Not because it's going to make any money, but again, it's that airbag if there's any downturns. If you get to your middle age, there's a lot of studies that prove, we all have heard the 60-40 approach. There's actually quite a bit of literature now that proves that actually that can't hurt you. It's probably more like 70-30, 70% equity, 30% bonds. Again, you have to be careful about which bonds because some bonds are not safe. And then as you get closer to retirement, it's probably more like 70-30 the other direction or 60-40 the other direction. Why? Because two reasons. One, bonds can provide regular income, which you'll rely on as you get closer to retirement, and bonds can be more tax efficient. Some bonds can be more tax efficient than others, or GICs. They're more tax efficient than money markets or GICs, other safe things, because there's a capital gain element. So that's all to say, when you're very young, you should have very little, some, but very little. As you approach retirement, you should have a lot, right? Still keep a lot, keep equity, keep some growth, but those equities should be dividend paying equities. And then in the middle, it's kind of a blend. So it's kind of a line. I don't know if you're familiar with economics, but like the demand supply, it's kind of a line. At some point, it crosses into the other, depending on age and depending on goal. And that's with respect to just retirement. Let's say you were buying a house. Let's say you were 20 and you wanted to buy a house. You gave yourself a 10-year time horizon. I mean, really, for probably 8 of those 10 years, it should be mostly equity, right? Because you're still young. If it doesn't work out, that's okay. You can keep renting. It's not a big deal. I mean, it's not ideal, but so it kind of depends on the goal. But for the most part, you start your investment career with very little, and you end your investment career with significantly more. And not all bonds are created equal. Do you buy oil, gas, oil? That word, mining. So it's a good question. I think what you maybe trying to get at is mostly ESG. We're not ESG focused. We do have an ESG portfolio manager on hand to evaluate those types of things. I mean, we're not going to buy tobacco companies. Okay, I'll tell you that. We're not going to buy media companies that are into adult material. We're not specifically targeting those things. And if it comes across our desk and it seems like it's a bit lewd, we'll avoid it entirely. But we are broad. There's some mandates that are broad top-down investors, and it's difficult to avoid it in certain cases. I mean, if you say, I would like American stocks, and rather than pick just tech or oil, I'm going to just buy them all. I'd like to just have exposure to all of them. You're going to end up with some tobacco. You just are. But for the most part, we don't invest in small and mid-cap companies, which is where those types of things tend to live. So to answer your question, we don't specifically target them. If they come across our desk, we'll avoid them. But in certain instances, it can be hard if you're buying a broader investment mandate. It can be difficult to avoid them. But we try to be as compliant in that area as possible. We definitely try that. All right. Again, I have. I'll finish with this in case there's no more. If you have questions about your personal portfolio, my pleasure. If you have questions about your personal portfolio, if you'd like a second opinion, I want to be clear. Although we would be very happy to have you, and I'm a graduate of the college, our founder is a graduate of the college. We have many graduates on staff. So we would love to have you on our platform. If it's not for you, that's no problem at all. I want to make sure that as a service, right, that this is John's dream. John's dream is to do a service to the ex-cadet and to the cadet community. And I'm a very, very small part of that service. And so it's no bother at all. If you have questions about your personal affairs, or you'd like a second opinion, or you'd like us to run your holdings that you have elsewhere through our system to make sure that they're appropriate, or if you have questions about fees, anything like that, as a service to the CMR and RMC community, as a service to the Canadian Forces community, I will make myself available. I will make my team available. And so this is a pretty public forum to be able to pose questions. But if you have anything that's more private than that, I want to be very clear. It is no bother at all. I sit at my desk until 8 o'clock at night every night anyway. I would be thrilled. My team would be thrilled to be able to help you. And so if you have questions or concerns, or you want a second opinion, it doesn't matter. I would very much encourage you to reach out to myself and the investment advisors who I manage, because we would, again, our fees are very low. We do not see it as a way of making money. We do not see it as a fundamental business line. We see it as a service to the ex-cadet community and to the community that is the Canadian Armed Forces. And we want to make sure that service is available to you and available to your families. So if you have anything at all, any needs, questions, comments, or concerns, Liam will give you my contact details, and I would be happy to make myself available.
That's perfect. Thank you so much, Jordan. And I hope everyone on the chat found this very informative. I think for me personally, like the advice that Jordan was able to bring to the table affects everyone, right? It doesn't matter if you're a student, recent grad, you saw my daughter on the camera, a young family, or going into retirement. I think those are all very true main tenets that everyone can kind of keep hold. So thank you again, Jordan, for your time. And this is one of many webinars that we would like to do on behalf of Canadian Alumni. So feel free to contact me, provide any feedback, whether tell me what you like, what you didn't like, or if there's something else more specific you'd like to see in the future. I'm always open and willing to receive feedback from people. As I mentioned at the beginning of the webinar, if you're interested in seeing what Canadian Alumni is offering as well from our connectivity platform, again, please don't hesitate to contact me. What we're essentially offering is a place for communities to stay connected, organize events, share news and updates, and ultimately benefit from your membership. We're actively recruiting beta testers from RMC, CMR, Royal Road communities. So I'm going to the Ottawa branch next week to give a demo, and we're working on onboarding some other classes as well. So if you're interested, you can contact Liam at CanadianAlumni.ca, and we can go from there. So again, thank you very much for taking the time this evening. I hope it was informative, and thank you again to the branch, to the team for putting this all together. So I'll hand it over to Andre for any closing remarks.
So thank you very much, Lion and Jordan. This is just great, and would like to do in the future is to have more of webinar. And what is the most important part of it is what you said, Jordan. You said you are open to help people, and what we will do on our side, talking to you and talking to Lion, is how can we make sure that people understand what you are able to do, what is your offer, which is very, very important, because don't forget, this webinar is registered. It's registered on YouTube. It will be available on YouTube as well as Facebook. So when you say you're almost like committed to do something, then believe me, I will work very hard to make sure that your word is going to the right place as much as we can. And we have a big network. We will use it as much as we can. So thank you very much. It was very, very interesting what you said. And, it's just the beginning.